There is one asset class that has protected wealth against inflation more consistently than any other in modern history. Not stocks, not gold, not bonds, real estate. And in 2026, with inflation running hot, interest rates elevated, and global uncertainty at multi-decade highs, the case for real estate as a core portfolio holding has never been more compelling. But the opportunities are not where they were 5 years ago. The market has shifted. Some sectors are struggling, others are thriving, and the geography of opportunity has changed dramatically. Today, we're going to break down exactly what's happening in real estate, where the money is flowing, and how you can access this asset class regardless of how much capital you have to deploy. This is POTENSIA. Let's get into it. Let's start with the fundamental mechanics. Why does real estate win during inflation? 2 reasons, and understanding both is critical. First, replacement cost. When inflation rises, the cost of building a new property rises with it. Materials, concrete, steel, lumber, get more expensive. Labor gets more expensive. That means existing properties become more valuable simply because they would cost more to recreate. Inflation puts a floor under real estate values by making new construction more expensive, which limits supply and supports prices on existing inventory. Second, rent growth. Leases have expiration dates. When they renew, landlords can, and do, adjust rents to reflect current market conditions. In an inflationary environment, market rents rise. That means the income produced by a real estate investment automatically adjusts upward over time. Unlike a fixed-rate bond, which pays you the same coupon as inflation erodes its purchasing power, real estate income grows with the economy. This combination, rising asset values and rising income, is what makes real estate uniquely powerful as an inflation hedge. Morgan Stanley Investment Management, one of the world's largest asset managers, has explicitly called 2026 an inflection point for real estate, expecting recovery in both values and transaction volume after 2 years of relative stagnation. Not all real estate is equal right now. Let's be specific about where the opportunities are and where they're not. Where the opportunity is, multifamily residential. Apartment buildings and multi-unit residential properties are the clear favorite of institutional real estate investors in 2026. CBRE's North American Investor Intentions Survey found that nearly 3/4 of surveyed investors cited multifamily as their top choice. The logic is straightforward. Housing demand remains strong. New supply has been constrained by elevated construction costs, and rental demand, particularly in Sun Belt markets, continues to outpace available inventory. Where the opportunity is, industrial and logistics. Warehouses, distribution centers, and data centers are experiencing extraordinary demand driven by 2 secular trends that show no signs of reversing: e-commerce growth and AI infrastructure build-out. The physical space requirements of AI data centers alone are creating demand for industrial real estate that is rewriting the supply and demand equation for this property type. Geographically, the Sun Belt. Cities like Charlotte, Houston, Miami, Tampa, and Raleigh-Durham are the focal points of institutional real estate investment right now. Strong population growth driven by domestic migration from higher-cost coastal markets. Strong job growth driven by corporate relocations and tech sector expansion. And critically, rental markets that remain undersupplied relative to demand, meaning rents are rising and investors are capturing that growth. Where the opportunity is not, office. The office sector remains challenged. Remote and hybrid work patterns have proven persistent. Vacancy rates in major office markets are at levels not seen since the early 1990s. Unless you are a sophisticated distressed asset investor with specific expertise in office-to-residential conversion, this is a sector to avoid in 2026. You do not need to buy a building to invest in real estate. And in 2026, for many investors, you probably shouldn't. REITs, real estate investment trusts, are publicly traded companies that own income-producing real estate. They are required by law to distribute at least 90% of their taxable income to shareholders, which means they typically pay substantial dividends. Current yields on diversified REIT funds are running above 3%, and that's before any potential price appreciation. There are REITs that specialize in every property type we discussed: residential REITs, industrial REITs, data center REITs, healthcare REITs. You can build a diversified real estate portfolio using nothing but publicly traded securities, accessible through any standard brokerage account, for as little as a few $100s. For investors who want the inflation protection and income of real estate without the complexity of property ownership, REITs represent one of the most efficient and accessible investment vehicles available. Real estate has created more millionaires than any other asset class in human history. Not because it's complicated, not because it requires special knowledge or extraordinary capital, but because it aligns perfectly with the most powerful forces in economics: inflation, population growth, and the fundamental human need for shelter. In 2026, those forces are working in your favor. The question is whether you're positioned to benefit from them. This is POTENSIA. In the next video, the topic is digital gold. Don't miss it. Until next time.